Hello everybody, it's Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or another episode of As the Housing Market Turns. Well, lots going on this week. It's almost like every day something new happens and we hear about other statistics or influencers that are pushing us closer and closer to having the housing bubble burst and back another housing crisis. So hear me out. We got a lot to talk about today. Interesting statistics. So our topics today are the U.S. home flipping report that was recently released, and we're going to speak about the shadow banking industry, the non-banks, how they are affecting and contributing to Housing Bubble 2.0 for sure here. All right, let's get at it. So the U.S. home flipping report was released by Adam Data Solutions the other day. It's really their sort of Q4, end of year for 2018 home flipping report. Of interest, it looks like there was a 4% reduction in the flipping of single family homes and condos for 2018 when compared to 2017. So 4% less were flipped. I guess you could say the volume in numeric terms of flipped homes was just under 208,000 flipped properties. So not too bad. I think it was 217 the year before. So again, a little decrease there. The average returns for flipping property was down 3% for 2018 compared to 2017. The average gross profit was $65,000, and that's down from about almost $67,000. So a little bit of a decrease right there. So clearly, the volume of flipped homes are going down, which is indication that maybe the market is either saturated or nothing's available or things are too expensive. So that's the scoop. And the reason why I say that is the total dollar volume for flipped homes with financing hit an 11-year high. So more and more people who were flipping were actually obtaining financing to do their deals. So typically it helps with the purchase, helps with the rehab, et cetera, et cetera. So more people sought financing to hit 11-year high. Now, as I said, it's clearly more expensive to flip a home these days. Property prices have increased. Obviously, in 2018, we hit a peak, so it costs more to obtain the home. Material prices were up. Things you buy at Lowe's and Home Depot, other places. I know, lumber was up, other materials were up, and also, skilled labor. Skilled labor force more expensive these days as well too. So it takes a lot of money to either build houses or flip houses, over the past year. Now, of note that's interesting, flipped homes that were sold to FHA buyers were down 17% from the previous year, and that's also an 11-year low. So for me, that's more like the fact that a lot of these FHA buyers are low down payment or first-time home buyers, and it's tougher for them to get into property. So chances are, it was expensive property and they're not able to do it. That's why it's 11-year low. So again, peak values, tougher to get people into these homes. And when you flip it, you buy it, you're looking down the road as far as getting a return on your money, and as as time goes on, you got to get that money out of your flip. So obviously prices are still expensive for flipped homes. Other statistics: so metro locations, MSAs, with 1 million minimum population, the highest home flipping rates for 2018 were found in Memphis, Tennessee, 11.7%, Phoenix, Arizona, 9.1%. Las Vegas at 8.7%, the Tampa, St. Petersburg area at 8.2%, and Birmingham, Alabama at 7.6% rounds out the top 5. The next 5 followed by Baltimore, St. Louis, Philadelphia, Orlando, and Nashville. So that's your top 10 flipping locations in the U.S. for 2018. Now, the homes that were a million people in the metro MSA that had the biggest flipping rate increases, so they actually increased in flipping volume from the previous year, were Boston, Tucson, Arizona, Raleigh, North Carolina, Columbus, Ohio, Hartford, followed by New York City, Charlotte, Grand Rapids, Michigan, Pittsburgh, Pennsylvania, and Milwaukee. That's your top 10 with respect to had flipping increases last year. Now, out of curiosity, there's always the metros that decrease. So the metros that decreased, the top 5 were Kansas City, Missouri, Buffalo, Indianapolis, Seattle, and Salt Lake City. So why flipping would decrease there? There could be a number of factors. Could be price points, could be lack of available homes to flip. There could be a lot of things going on there. It'll take more investigation to figure that out. I mean, Seattle, I would say possibly. It's just a nature of dollar value because it was so expensive there. Places like Buffalo could just be not many homes are available to flip or not a desirable place to move to. So who knows? Not pointing out Buffalo, but just an example. There could be other factors here that we're not aware of. Now, realize that it still takes about 6 months to flip a property. For 2017, the average number of days to flip was 181 days. For 2018, it was 180 days. So flippers did better by 1 day. But again, 6 months from start to finish. So still quite a long time to flip a home and get involved in the project. And realize that the average size of homes that are flipped are also getting smaller every year. So the size of a home in 2018 was 1,408 square feet. And that I know has been decreasing over the years. So what that means is that as homes are harder to find, flippers and rehabbers, investors are actually having to probably change their avatar home. They've got a box, we want a 3-2, 1,500, 1,700 square feet, whatever that number is. Well, because of lack of inventory or lack of choice that's available, they're having to sort of, lay off a little bit on their standards and probably pick up smaller homes, maybe 2-2s, etc. Who knows? But again, realize that in order to do the business, you got to change some of your philosophies if you want to make money, and that's what people are doing. So they're trying to work with the times. So there's competition, and that's a situation here. Excuse me, got a bit of a cold. The gross, I don't know if I mentioned this too, but the gross number of homes flipped were just under 208,000 homes flipped. So when you look at that number, thinking about how many investors there are across the U.S., I'm going to say there's probably 20 million investors, and I've done some research to get me towards that approximate. I mean, if you actually look at some statistics, I think there's over 10 million people own more than one property, and that was just done by finding names in property appraiser databases looking for same name, multiple properties. So, say there's 20 million people out there looking to do in real estate investing every year, yet only 208,000 homes were flipped. That's not a really good ratio on homes per investor, so to speak. So it is very competitive out there, and that's what drives prices. Let's take a look here. Okay, so we talked about that. And again, what does this really mean? Well, competition's out there. And, I know a lot of people in our area that do this. They do a good job at it. It's tougher for everybody to obtain properties and get their hands on them. So hopefully as inventory comes on, there'll be some opportunities for people to get involved. But going back down to some of the issues with respect to financing, I think that's a lot of risk going on here, because one of the perspectives you may have is that if you're flipping homes or if you are looking to do that business, everything is based on what's called the ARV, after repair value of the home. So you buy a home for X, you improve it by whatever, and you hope to sell it for whatever that number is down the road. Well, we've proven here that the average time to flip is indeed 6 months. So if you buy a property today, you're basing your future revenue, your potential, on what's called the ARV, but you're looking at that ARV 6 months down the road, which is a bit of a stretch now. And we know that you're basing that ARV with comps that you have readily available, comparable sales property, and those comps are from 30 days back, 60 days back, 90 days back. Sometimes people are stretching 6 months back. So if you think about it, you're looking at a project today and having to determine what the future value is going to be 6 months from now based on the previous 3 months or maybe 6 months worth of comparables, which were higher than which we are we've hit the high. So 6 months ago, we hit the highs. We were there. So that's kind of the situation where people find themselves in. I talked to a lot of people who asked for advice on just that situation where I've got a home, I can buy it for X, and I'm being told the ARV is going to be this over here. And from my perspective, we know with increased inventory, with seeing a plateau in prices, with seeing buyers pull back, we know that prices will decline. So if your project's going to take you 6 months, you have to factor in some sort of ARV decline for the future. If you don't, then I think you're exposing yourself big time. And coupling that, if you're taking or using financing to do your fix and flips, whatever you're doing out there, I think you put yourself in a lot more risk with respect to what's going on in the future. So we're using highs that just happened to determine our potential volume and our potential, I guess you could say, not volume, but our potential revenue stream, because we had good numbers over here and we're projecting those out 6 months in the future. But we know we've already seen declines, slowdowns, more inventory, the whole bit. So just saying, buyer beware. Understand that those ARV numbers can shift negatively, and that could be the difference of you making money or losing money in the project. So please keep aware of that. To me, that's the number one thing that people ask me. How do I figure out what the ARV is, or how do I determine whether the ARV I've been told by real estate agents, other investors trying to sell me the property, are decent numbers? And I can tell you 9 times out of 10, they're not decent numbers. And most times, I just did some this past week for people that I know, and a real estate agent could pull 1 property out of 10 that hit the maximum, and that's what they're banking their number on. So if you don't do your due diligence, you're going to be sorry down the road here. Okay, so let's move on to what's called the shadow banking industry. And when I look at comments on YouTube and social media, not just my videos, other videos, when I see these comments, for people who don't believe that we're actually in some sort of housing bubble situation right now, if they deny it, they think we're smoking whatever, they think we're full of it. The number one sort of pushback or argument I see, this is from people that comment, and also from what I see from the mortgage professionals, the generalized real estate agents, whatever. We see they utilize this term or this phrase that, it's different now because we have much tighter lending guidelines. So we're not going to see the same effects of bad lending we saw back 10 plus years ago. So please remember that I just said that, okay? That seems to be the number one, that squashes, we're in a housing bubble. No, we're not. We have tighter guidelines, better guidelines. We're not going to have the same issues with mortgages. So that's what the number one pushback is. Well, I think that concept may be a little bit false, and I think it's changing today, and I think people who are saying that aren't aware of what's going on in the industry. And please realize that lending guidelines were much tighter right after the last housing crisis. They had to be, and they were. And I recall people who were looking for a mortgage that had a 750 credit score, 6-figure incomes, couldn't get approved because lenders were scared to issue loans because of what happened. So those people paid the price for lenders' mistakes, evidently. But the whole point, though, is that we don't loan to people with poor credit or financial issues. That's what was going on right after the last housing crisis. Well, things change, and because lending was slower and lenders are out there to make money, slowly, year after year, quarter after quarter, guidelines have changed, and some of the mortgage origination providers have changed or augmented as well too. So realize that everyone remembers the first housing crisis, and if you ask what occurred or what caused it, people will say it was subprime mortgage issue, subprime crisis, mortgage meltdown, which sort of started it. So I have to agree, there's a starting point where things happened. A lot of the variable rate mortgages that were given to people with fixed incomes had problems when they did change, and the fixed income couldn't change, so therefore people couldn't pay extra and absorb that increase in housing expense, and ultimately they lost their homes to either foreclosure or short sales. That did happen. That kind of kicked everything off, but realized that the subprime mortgage crisis, mortgage meltdown, wasn't the be-all, end-all. That was about 20% of all the mortgages. Conventional mortgages had their issues. One of the main culprits were cash-out refi, so people who were taking money out of their property to purchase other homes that they bought as investments, to purchase boats, cars, trips, big screen TVs, whatever you do with your money, that was the deal. Now, when you equity strip your home, the thought process is you're going to use the money to improve, update, increase the square footage. In other words, put value back into your home, so when you sell it, you can pay off that money you took out and still make money, etc., etc. So that was the premise behind that. Well, that wasn't what actually happened. So a lot of the people got burned on the fact that they took money out. When it was time to repay it, they couldn't do it. Simple as that. So that's what really happened. Now, with mortgages today, things have changed. They've changed a lot, and they've changed kind of big time. So the traditional banks that are out there, like Bank of America, Chase Bank, Wells Fargo, those banks are lending less and less in the mortgage arena, that's for sure. So there's a group called the shadow banks, or often referred to as the non-banks, shadow banking industry, whatever you want to call them. They are now the number one lenders and issuing originators of mortgages for the past number of years now. They've got the market share. This is what's actually going on. So what is a shadow or non-bank, if you really ask and you don't know? These are entities that aren't really, they don't take deposits from customers. So that's number one. So you don't go to a non-bank and open a checking account and they hold your money and you put your direct deposit pay in there or whatever. They don't do that. All they're doing is financial things like mortgages and other loans, etc. So therefore, because they don't take deposits, they're not regulated by the Federal Reserve, the FDIC, the OCC, etc. So they tend to sort of fly under the radar with respect to what's going on in the banking industry. Now, you've heard the names before, obviously. Quicken Loans, Pennyback, Caliber Home Loans, etc. There's a whole bunch of those. You see commercials for them. You can take your smartphone and you can apply online and get pre-approved. You see all their ads when you're on various websites wanting to click and go and get your pre-approval, etc. So that's going on out there right now. And they're basically dominating the mortgage market as we speak. But the issue is that they originate the riskiest amount of loans in the industry. Now, a report released this month by MBA, which is the Mortgage Bankers Association, stated that the non-bank lending surged from about 24% of all mortgages back in 2008 to 54% of all mortgages in 2017. Now, I can tell you, reading what's happened in 2018 as well, too, that it has continued to increase. So the non-banks are your primary mortgage originators out there right now. At the same time, obviously, the share of originations done by the traditional banking system has plunged over the time frame. Now, the government, and this is mainly FHA, which is the Federal Housing Authority, is on the hook for these mortgages. They don't buy them, but they insure them. They ensure that they'll get paid if there's a problem. They insure, and the money used to insure them or to pay back, in theory, is based on premiums they're charging the borrowers, etc. So the problem, though, is the shadow banks will not be bailed out if there is another crisis out here. The investors will have to take the loss. Now, so why am I focusing on this? Well, a report that was released the other day by what's called the American Enterprise Institute, otherwise known as AEI, outlined how higher home prices are actually pushing mortgage lenders to take greater risks when they're originating mortgages for borrowers and homeowners. So as values go up and properties are more expensive, instead of actually tightening and being more controlled and eliminating risk, we're actually offering riskier loans with more exposure to home buyers for them to jump on board here. So these non-banks are issuing mortgages that are way over the upper DTI limit, and DTI means debt to income ratio. So when you take your 100% of your monthly income, the debt to income ratio is the amount of housing expenses allocated out of your entire monthly income. So what's called a qualified mortgage, QM, that's set and defined by the Dodd-Frank Act. So the DTI for a qualified mortgage as per the Dodd-Frank Act is 43%. So 43% of your monthly income can be allocated to your housing expense. That's the DTI right there. Well, we know that back about a year plus ago, Fannie Mae raised their DTI up to 50% in 2017, so encouraging more buyers to jump in. And just so you understand where things are at, in November 2018, a record 60% of all FHA insured purchase mortgages exceeded that QM, the qualified mortgage DTI level limit. So 60% of all mortgages were above, by FHA, were above 43% debt to income ratio, which is huge. 50% of all VA mortgages originated in November exceeded the QM debt to income ratio limit as well too. So essentially what's showing here is that FHA, VA, even Fannie and Freddie not as much, but they're still up there, are issuing mortgages with higher debt to income ratios, and that's really being offered to riskier borrowers. So it's no coincidence we see here that rising debt to income ratios are following rising home prices. So the government is really stimulating riskier buyers to jump into mortgages to purchase property that's expensive. And again, when you're at 50% DTI or more, when 50% of your income is being allocated to housing, that's quite a lot of money allocated to housing expense. If something happens to your income, you lose your job, you get laid off, you get your hours cut, something changes, well, you're exposed big time. And as simple as that. So that's not very, and that's where we say we're into more risky loans now too. Now, going back to what's called the GSEs, government-sponsored entities, and that's, Fannie, Freddie, FHA, VA, whatever, all those groups. The GSE loan share with debt-to-income ratios over 42% right now, so in today's time frame, is almost the same as it was back in the peak of 2007, just before the last housing crisis. So what I'm saying here is that the number of riskier mortgages, or riskier from a debt to income perspective, is here 10 years ago, and we are almost here right now. We're literally a couple percentage points off. So for those of you who say that we're controlling and we're tightening our guidelines for lenders, we're doing the opposite. We're actually making it easier for people to qualify for mortgages because we're raising the threshold of the debt to income ratio. And that basically is just, what that means is that that's being offered to probably lower credit people who have credit blemishes, and blemishes could be judgments, it could be bankruptcies, foreclosures, short sales, other things that are going on, settlements. All right, it could be, we're not doing full documentated loans anymore. We can do stated income or no doc or limited doc. There's all these things that are happening now. So in order to originate loans, we are doing exactly what we did over 10 years ago, which is opening things up as property prices are rising or have risen to their peaks for the time frame we're in, to more and more people, and we've loosened our guidelines. And that's the number one thing, is that high prices and lessening or relaxing guidelines is the recipe for disaster coming in the future. So that's the scoop. So just so we are clear, the non-bank segment issued 94% of FHA-backed refis in November. So 94% of the issued loans were FHA-backed for refis in November, and 85% of FHA-backed or insured were purchase mortgages in November as well too. So that's a lot of risk for a lot of loans, all right? And so the government is encouraging this. It's encouraging higher DTI limits. It stretches the buyers to their financial limits and really exposes them. If they have any issues, in the next little while, they are exposed to a situation that could land them down the road to default, and that is not a good thing. So as far as I'm concerned, everything's come full circle. So it's just the nature of how we got here. We're not having the same mortgage meltdown that sort of kicked off the last housing crisis, so to speak, but we're having the same thing happen again, just maybe in a different order, all right? And I think we're already in a housing crisis, and we start seeing the inventory that comes on, price reductions and whatever, all those things are the starting point for the housing crisis. This will be one more catalyst to kick things over. So again, as far as I'm concerned, the standards were tightened out of the last housing crisis, and they've been relaxed for the past probably 5 or 6 years. And they continue to get more and more relaxed, and lenders are looking at just different ways, different programs to make it easier for buyers to buy those expensive homes, which puts us at risk, and as far as I'm concerned, starts the whole cycle all over again. So for those of you who don't think we're in a housing bubble, who don't think we're in a position of potential crisis, you might want to rethink that, because this is what's going on right now. And again, if I get a higher interest rate with a low down payment loan and I'm stretched to my maximum debt to income ratio, I am a good candidate to default if something changes in the marketplace or my personal finances, and I could be stuck and I'm not paying my mortgage, and therefore I'm now going to be part of that next housing bubble crashing, which turns into a crisis. So please keep that in mind. And to tag along, one more thought to tag along with that, mortgage fraud. So typically when prices increase and buyers jump in and standards loosen, we see mortgage fraud increasing. So yes, the amount of mortgage fraud, there's a mortgage fraud index rate, etc. It was up 4.6% from January compared to the previous month of December. All right, so 1 month jump of 4.6%, and that is a 9.6% year-over-year increase from January 19 to January 2018. So right away, we see almost 10% year-over-year increase in mortgage fraud. What is mortgage fraud? Well, mortgage fraud can be anything from legitimate, fraud. What it boils down to, it could be name fraud, it could be usage fraud. What I mean by that is you say you're going to use the home as a primary residence to obtain a lower loan to value LTV on your mortgage, yet it's really going to be an investment property. You forge people's names, you lie on your documents, there could be some title confusion, things like that. So fraud can be many different things, not necessarily financial dollar value fraud, but what this is, it leads to houses being purchased by people whose intentions aren't to live there, whose intentions are to make a buck, whether it's through rental or fix and flip or just flipping the property. And of course, when things change and values change and money tightens up, that's the first segment that walks away from the loans and doesn't care about the property because they've got nothing invested because they did purchase it through fraudulent activity. So just realize that that's up. So all the things that I talk about mimic what happened 10 plus years ago. So if you don't think we're facing a housing crisis or a housing bubble that's going to be bursting or is kind of bursting in some locations, you may want to look at all those things. Write down what happened 10 plus years ago and what's happening right now. You're going to find we have a heck of a lot of similarities between the two time frames and two markets. So that's the scoop, guys. So again, thank you for your viewership and watching. I appreciate it. Please like and comment if you like. Share the video too. That would be great. I would love subscriptions if you like what you hear. We'll talk more about this in the future, but please subscribe to my video, to my channel. And obviously I'm trying to get back to people. As I mentioned, I've hit a few more people up now, so I'm getting through that. Hope to get more done this income. I know you've all had questions. I'm trying to work on that and get through, but as I mentioned, I do like to do a little bit of research on your locale before I come back with you with an answer or some thoughts on what you're asking. Now, I have an event coming up here in Tampa. It's on March the 16th. It's called a Distressed Property Summit, and what it really is a full day worth of training on a lot of what we talk about here in the housing market. We talk about ways to earn income and build wealth in a down market or a market that declines, and I show you where the opportunities are. So if you're in the greater Tampa Bay area, you may want to check it out. It's distressedpropertysummit.com. I'll put the link up in the comments section, but it's just a very straightforward URL. You can register and get your tickets there. So again, everybody, thank you very much, and we look forward to speaking with you next week.